Silver touched $64.50 per ounce. Headlines scream new all-time high. Financial media celebrates. Investors pile in with fear of missing out, FOMO. But here is what they are not telling you. This record was not just set. It was locked in weeks ago when something broke in London that most people still do not understand. While everyone watches the price ticker flash green, the real story is happening in the vaults. And what is happening there suggests this rally to $63 is not the top. It is the floor. The trap has already been set, and the target is not $70 or $80. The mathematics of what happened in October and November points to something far bigger, something that could entirely reshape our understanding of precious metals. Yes, silver hit $64.50. Yes, that is a new nominal record. But the why reveals everything about where we are headed next. The day before, on December 10th, the Federal Reserve cut interest rates by 25 basis points at their FOMC meeting. Standard stuff, expected move. Market analysts had priced it in. But silver did not just rise modestly on dovish Fed policy the next day. It exploded $2.45 in a single trading session. That is a 4% move in one day for a metal that is supposed to be less volatile than crypto. Think about that for a moment. When was the last time you saw gold move 4% in a single day without a major global crisis? Why did silver rocket like this? Because the Fed rate cut was just the match. The powder keg was already packed and waiting, loaded with months of accumulated pressure that most traders completely missed. Here is the mechanism most analysts got wrong. When the Fed cuts rates, the dollar typically weakens. When the dollar weakens, commodity prices usually rise. Basic economics, but silver did not rise like a commodity responding to monetary policy. It rose like an asset in physical shortage, getting bid up by desperate buyers who need actual metal, not paper contracts or ETF shares. The tell? Look at what happened before December 11th. The entire month of December, silver was consolidating in the $57 to $60 range, not crashing back to $50, not correcting after a big run, just sitting there holding gains, waiting. That is not normal price discovery where sellers and buyers find equilibrium. That is constrained supply meeting persistent demand. That is a market where the physical metal is already spoken for. And every Fed rate cut just tightens the noose around the shorts who promise delivery they cannot make. Now, let me tell you about October 2025, the month when the trap was actually set, the month that explains why $63 is just the beginning. Something extraordinary happened in London that month, something that should have made front-page news but barely registered outside specialized metals trading circles. Silver lease rates, the cost to borrow physical metal from vault holders, exploded to 200% on an annualized basis for overnight borrowing. Read that again, 200% annual interest to borrow silver for just 24 hours. To put that in perspective for you, normal lease rates for silver run 1 to 3% annually. In times of market stress, they might spike to 10 to 15%. During the 2008 financial crisis, they briefly touched 20%. But 200%? That is not stress. That is not even a crisis. That is full-blown panic in a market that is supposed to be liquid and functional. Who pays 200% overnight rates? Traders who are forced to deliver physical metal they do not actually have. Short sellers who sold paper contracts but now face physical delivery. Demands from buyers who want the real thing. Financial institutions that promised metal to their clients but suddenly cannot source it from the market at any reasonable price. Rona O'Connell, head of market analysis at StoneX, said it plainly in an October interview. There was basically no available metal left in London. Think about what that means. London is the global hub for precious metals trading, the physical marketplace where institutions around the world source their silver. And in October 2025, it ran dry. One trader who was there described the scene to Reuters. A lot of people were very stressed, to put it mildly. That is trader speak for absolute chaos. This was not a temporary blip that resolved in a day or two. The numbers tell the deeper story. London Bullion Market Association, LBMA, vaults held 31,023 metric tons of silver back in June 2022. By March 2025, that number had fallen to 22,126 metric tons, a one-third decline in less than 3 years. And by October 2025, when lease rates hit 200%, the available metal for immediate delivery was effectively zero. Every ounce that was not already allocated or spoken for had been drained from the system. The trap snapped shut on everyone who thought they could short silver with impunity. But the story gets even more interesting here. One month after the London crisis, in November 2025, the United States government officially designated silver as a critical mineral essential to national security. This was not symbolic politics or bureaucratic paperwork. The U.S. Geological Survey does not hand out that designation lightly. It is reserved for materials that meet 3 specific criteria. They must be essential to our national defense and economic security. They must be vulnerable to supply chain disruptions, and they must be concentrated in foreign sources we do not fully control. Silver just joined rare earth elements, lithium, and cobalt on that list. Think about that for a moment. Our government looked at the complete physical shortage in the world's largest trading hub in October and said, "We have a strategic problem here. The record price at $64.50 is just the market starting to price in what happened in October and what Washington confirmed in November. The real move, the move that takes us to triple digits, has not even started yet. Because once the market fully understands that the physical metal is gone and industrial users are about to start fighting over what is left, $63 will look like the bargain of the decade. The numbers that Wall Street does not want you focusing on too carefully: supply and demand." The Silver Institute released their 2025 World Silver Survey in November, roughly the same time our government declared silver a critical mineral. Interesting timing, do not you think? The numbers they published are stark. 2025 global mining silver supply, 813 million ounces. 2025 global silver demand across all sectors, 1.12 billion ounces. The deficit, 307 million ounces. That is not a typo. We are consuming 307 million more ounces than we are pulling out of the ground this year. But here is what makes this truly alarming. This is not just a 2025 problem that just popped up. This is a structural crisis that has been building for years. While everyone was distracted by crypto and tech stocks, this marks the 5th consecutive year the silver market has been in a deficit. For 5 straight years, we are consuming more silver than we mine. So where does the deficit get filled each year? Recycling and existing stocks sitting in vaults and warehouses. But here's the problem that is now catching up with us. Recycling cannot keep pace with industrial demand growth, and those existing stocks are exactly what disappeared from London vaults between 2022 and 2025. Philip Newman, managing director at Metals Focus, presented these findings at the Silver Institute's annual industry dinner in New York. When someone asked him about the supply outlook going forward, his answer was blunt. Mine production has been essentially flat for years, while structural industrial demand is rising. This is a diplomatic way of saying we are running out and new supply is not coming to save us anytime soon. Using conservative numbers, the total cumulative deficit from 2021 through 2025 is 1.2 billion ounces. This means 1.2 billion ounces consumed from above ground inventories in just 5 years. To put that in perspective, that is 1.5 years of total global mine production, drawn down from stockpiles that took decades to build. Now, let us talk about where the physical metal is going and why it is not coming back into circulation anytime soon. As of December 2025, the largest silver-backed ETF, the iShares Silver Trust, holds 15,415 tons of physical silver in vaults around the world. That is 495 million ounces locked away. To put that in context, global silver mine production in 2025 is 813 million ounces. This one ETF alone holds 61% of 1 year's entire global mining output. Add in the other major silver ETFs, and you're looking at over 700 million ounces locked in ETF vaults worldwide. This is completely unavailable to industrial users who desperately need silver for solar panels, electronics, and electric vehicles. And here's the kicker that creates the trap within the trap. When silver prices rise, ETF inflows actually accelerate. It becomes a self-reinforcing cycle. Investors see silver going up. They pile into ETFs to catch the move. Those ETFs buy physical metal and vault it, and that metal does not circulate back into the industrial supply chain where manufacturers need it. Morgan Stanley noted this dynamic in their Q4 2025 commodities report, and their language was surprisingly direct for a major bank. Silver ETF inflows have created a self-reinforcing supply squeeze. Higher prices drive more ETF buying, which removes more physical metal from circulation, which drives prices higher. They are describing a feedback loop with no natural stopping point except much higher prices, or industrial users finding substitutes. Only solar photovoltaics consumed 232 million ounces of silver in 2024. That is nearly 30% of total global mine production going into just one sector. And that number is not plateauing or declining, it is accelerating. China installed record solar capacity in 2025, and global solar installations are projected to double by 2030 under current green energy mandates from governments around the world who have committed to net zero targets. Here is why solar manufacturers cannot just switch to something else. Each solar panel requires silver for electrical conductivity in the photovoltaic cells. There is no perfect substitute that performs as well. Add electric vehicles into the equation, silver in EV motors, battery management systems, and charging infrastructure. Add AI data centers that are being built out at breakneck speed, silver in servers, cooling systems, and high-performance computing hardware. Add fifth-generation 5G telecommunications infrastructure, silver in antenna systems and circuit boards. The Silver Institute expects industrial demand to remain above 665 million ounces annually through 2030. That is 81% of current mine production before you even count investment demand, jewelry demand, or coinage. Let me repeat that. Industrial users alone will consume 81% of everything coming out of the ground. Here's where the $64.50 record gets really interesting when you put it in historical context. Because the headlines about all-time highs are technically true, but deeply misleading. The previous nominal high was $49.95, set back in January 1980 during the Hunt brothers' infamous attempt to corner the silver market. That was manipulation. But the financial media is not telling you this. Adjusted for inflation using standard CPI calculations, the 1980 peak of $49.95 equals roughly $200 per ounce in $2,025. Let that sink in. We are celebrating a price that, in real purchasing power terms, is less than 1/3 of where silver traded in 1980. And here is the crucial difference between then and now. The 1980 spike was artificial manipulation by two individuals trying to corner the market. Today's move is driven by fundamental realities that cannot be manipulated away. Structural supply deficits, 5 consecutive years, physical shortage, London vaults running empty, strategic government designation, and accelerating industrial demand. Let us do the math everyone is avoiding. The calculation that explains why $100 plus silver is not speculation, or the wishful thinking of silver enthusiasts. It is mathematical inevitability. Let us talk about the gold-silver ratio, because this is the most reliable indicator of where silver is heading next. And right now, it is flashing the same signal it flashed before silver's biggest moves in history. In April 2025, the ratio hit 107. That meant it took 107 ounces of silver to buy 1 ounce of gold. Silver was extremely undervalued. By October 2025, the ratio had fallen to 78 as silver started catching up. By December 2025, we are around 65 to 68, and silver's momentum is building. Here is why that matters. In 1980, during the Hunt brothers saga, the ratio collapsed from 40 down to 17 as silver exploded from $10 to $50. In 2011, during silver's last major bull run, the ratio fell from 65 down to 31 as silver surged from $30 to $48. We are at 65 to 68 right now, sitting right at the same level where silver took off in 2011. Take gold at its current level, around $4,200 per ounce. Divide that by 40 and silver becomes $105. But what if the supply crisis we are facing pushes the ratio even lower than 40? At a ratio of 30, which we actually saw as recently as 2011, you get $4,200 gold divided by 30, which equals $140 silver. The ratio is not just falling because silver is catching up to gold in some abstract way. It is falling because silver has something gold does not have: massive and growing industrial demand that cannot be substituted away. When physical shortage meets industrial necessity, when solar manufacturers and EV producers need silver and cannot get it, the ratio can compress violently in ways that shock even experienced traders. Here are the specific catalysts to watch as this unfolds. The timeline that takes us from today's $63 to $100 plus over the next 9 months. Q1 2026, January to March. Watch for Chinese solar installations to surge after the Lunar New Year as manufacturing ramps back up. Watch for ETF inflows to continue if the Federal Reserve maintains its dovish stance and cuts rates again in January or March. The target range for this period, $70 to $80 per ounce. Q2 2026, April to June, U.S. solar projects accelerate ahead of the summer installation season when weather is optimal for large-scale construction. London. Vault inventories get tested again as industrial users stock up for peak manufacturing season. Target range, $85 to $100 per ounce. Q3 2026, July-September. Peak solar manufacturing season hits as factories produce panels for winter installation deadlines. If supply conditions have not improved, we could see a second lease rate spike similar to October 2025. Industrial users start panic buying to secure supply. Target range, $100 to $120 per ounce. The record at $63 is not the story. The story is what the October lease rate spike and November critical mineral designation revealed about the true state of the silver market. The physical metal is gone. Industrial demand is accelerating regardless of price. And price is now the only rationing mechanism left to balance a market that has been out of balance for 5 straight years. The trap was set in October, when London ran dry and lease rates hit 200%. The $63 record is just the market beginning to realize the trap exists and starting to price in the implications. $100 plus is what happens when it fully closes, when every industrial user, every investor, and every government that needs silver for strategic purposes simultaneously realizes there is not enough to go around at current prices. This is not about fear or panic. This is about understanding the mathematics of a supply crisis that has been years in the making and positioning yourself accordingly before the full weight of that reality hits the broader market. The institutions already know. That is why lease rates hit 200%. That is why our government designated it a critical mineral. Now, you know. I will continue to convey these analyses to you in the clearest way possible. You can follow my channel to get information about future videos and learn these ideas before anyone else. Subscribe and turn on notifications. Because there are 3 weeks until January 1st. You must not remain disconnected from information and developments, as the market never stops. The timeline is set. The model is clear. The only question is, are you ready for this?